Listen closely, because I'm about to call out one of the biggest lies traders still believe. Most of you treat support and resistance like magical lines that the market is somehow obligated to respect. And that belief is the fastest way to get liquidated. If you've ever watched price bounce perfectly from your level, only for the next touch to nuke straight through it, this video is the clarity you've needed. The truth is simple. Support and resistance don't fail because the level was wrong. They fail because you misunderstood the behavior behind the level. And today, I'm going to break that illusion cleanly. Before we go deep, let me ask you something. Think about your last perfect setup at support. What were you really trading? The structure and intention of the market, or a line you drew because everyone else draws it? If you're honest, you already know the answer. Let's start with the ruthless truth behind support and resistance. Most retail traders don't trade levels. They trade hope. They see a bounce, draw a line, call it support, and then expect price to repeat the same behavior simply because it happened once. That's not analysis. That's emotional attachment disguised as strategy. The market doesn't care about your lines. It cares about liquidity, efficiency, and delivery. And if you can't read the behavior behind the bounce, you're not trading structure. You're trading superstition. Here's what support and resistance actually represent. Areas where price previously paused because the market was balancing orders. That's it. A pause. A moment where buy and sell pressure temporarily reached equilibrium. Calling that support without understanding why it paused is like calling any door a vault. You're missing the intention entirely. So let's break this down properly. First, you identify the behavior. Support and resistance aren't just horizontal levels, they're reactions. They show you the personality of the move. Was the pause aggressive, weak, manipulative, smooth, chaotic? Each one reveals a different intention, but if you only see a line, you'll never interpret the intention behind it. Once you see the behavior, you interpret the structure. Did the market create that level while trending strongly or during a tired, sloppy correction? Did price build and accumulate before touching it, or did it slam into it impulsively? These details matter more than the level itself, because the structure tells you whether that zone is likely to hold or whether the market was simply building a trap to hunt later. Now you anticipate intention. And here's where most of you blow up. You assume support is a buy zone and resistance is a sell zone. Wrong. Support can be the staging ground for a breakdown. Resistance can be the launch pad for continuation. It's not the level that matters. It's how price delivers into the level. Slow, hesitant delivery tells you one story. Fast, hungry delivery tells you another. Ask yourself every time, what is the market trying to achieve by revisiting this area? That one question flips your entire analysis. Let's anchor this with a scenario. Picture price returning to a support zone. Retail thinks nice, double bottom, I'm buying. But you notice something different. Price isn't rejecting sharply, it's grinding, tapping, absorbing. That's not support holding. That's liquidity building. That's the market collecting orders from traders who are convinced the level matters more than the behavior around it. If you've ever been faked out at a level, no, you weren't faked out. You misunderstood the intention. Think about the last time price broke your support and then reversed instantly. You probably thought it was manipulation. It wasn't. It was the market cleaning out weak hands who were trading drawings instead of behavior. Drop a comment if you've seen that pattern play out over and over, because it's one of the most common reasons traders lose. Support and resistance only matter when they align with structure, intention, and delivery. They're not independent zones of reversal. They're checkpoints. They're tests. They're moments where you evaluate the strength of the market, not moments where you blindly trade it. Most traders fail because they forget this. They get attached to levels instead of the logic behind those levels. The market leaves clues in every reaction, every pause, every shift in delivery. Support and resistance are just surface-level markings of deeper intention. The traders who win aren't the ones who draw the straightest lines. They're the ones who question why price respected the line in the first place and whether the market still has a reason to respect it now. If you start analyzing the intention instead of worshipping the level, your entire trading edge changes. You stop reacting, you start anticipating, and that's the difference between taking random touches and taking high-quality trades with discipline and confidence. That's the edge. Use it.